Hello, this is Eric Parnell, Chief Market Strategist from Great Value Advisor Group with today's latest market insight. Joined today by Evan Coffey, investment analyst on the asset management team. What are we talking about today, Evan?
Well, Eric, what's certainly been top of mind for many investors and the talk of the town here at GVA is that with a new week comes a new massive AI deal. This past Monday, OpenAI announced their latest partnership agreement with chip designer Broadcom for 10 gigawatts of processing power. The two companies will co-design the GPUs together, and this is the latest deal of this nature that we've seen over the last 3 months. So just a week prior, they announced a very similar deal with another chip designer, AMD, for 6 gigawatts of compute. And if we flash back a month prior to that, they announced a major deal with the mothership of chip design, Nvidia, for an additional 10 gigawatts of processing power, valued at approximately $100 billion. Now, these are just the latest headlines. We've seen a number of these deals take place over the last year with companies like Oracle, Intel, Google, SoftBank. I could go on and on. And I think that this is top of mind for many investors because it's pulling the market along. This trade is rumbling along. And while there are talks of a bubble, which we'll get into, investors like the shiny object. And so with that being said, I think it ties well to what we've talked about on Market Insights, which is the concentration at the top of the market and how those two intertwine. So I don't think I would go as far to say that we're in a bubble right now, but I would certainly say that we've got some froth at the top of the market. Mm-hmm. Once again, the S&P 500 is near or at all-time highs at the time of filming. And beyond that, CapEx levels are at historic highs. I keep going back to that astounding fact that the AI spend now in the United States makes up a greater share of US GDP than the consumer spend. That to me is a telltale sign of where markets are focused right now. So if we combine statistics like that mixed with the idea that OpenAI has made over $1 trillion worth of deals or promised $1 trillion worth of deals in just the last 6 months, any rational investor is going to question whether this is sustainable. Mm-hmm. So my first question to you as a rational investor is this sustainable? And then second, to the bubble question, is this time around different? Everyone likes to bring this back to the turn of the century, the dot-com bubble. And, the answer on the flip side is those companies were not profitable. They were the pets.coms who didn't have any earnings, while companies today are making money hand over fist. So it's a two-parter question. First, is this sustainable? And second, is this time different?
No, those are good questions. And I would say, are we in a bubble right now? Well, we're bubble adjacent. You take a look at the valuations associated with these companies right now, and they are at an extreme. But we should be prepared for them to become more extreme before it's all said and done, because AI is real and the spending is real. And there is an abundance of liquidity that's out there in the marketplace today. So we should reasonably expect that spending is going to continue, at least for the near term. Now, with all that being said, we've been here before. This feels a lot like October 1999 in certain respects, where, you go back to the latest or the most recent technological revolution prior to AI, and that was the advent of the internet. And, you saw the same type of statistics being talked about, this massive amount of spending in order for everybody to get onto the internet, and companies, of all shapes and sizes spending to the nth degree and doubling and tripling their spending on an annual basis in order to get onto the internet. We're seeing the same exact thing taking place with AI today. But the one thing that's important to remember is that when it comes to stocks, it's not necessarily about the absolute spending that's going on. It's about the marginal spending. Are those growth rates continuing? Are the profit margins continuing to expand? There will be a threshold that we reach at some point where the pace of growth starts to slow. And it's at that point that investors are going to have to make the hard decision to say, can I justify these extraordinary valuations? And there's another element to tack into that. There's a huge inflow of liquidity into the market right now. The Federal Reserve is back to cutting interest rates, despite the fact that we have an economy that's continuing to grow strongly, and asset prices are at near all-time highs. If we run into an environment in the coming months where there's a reason why the Fed has to turn path and maybe not cut interest rates anymore, or if there's some need for liquidity to be withdrawn from the system, that could really rattle these stocks and lead to some much greater volatility than what we're seeing right now.
Well, I'm glad that you mentioned what can rattle stocks, because that's what I want to get into next. With all of this talk of an AI bubble and market concentration, it seems like this is a runaway train up until last Friday, when I feel like we saw what has been the kryptonite for equity markets in 2025, tariffs. Once again, this past Friday, we saw a social media post from President Trump stating that he would impose an additional 100% tariff on China starting next month. This was in response to Beijing's efforts to restrict the exports of rare earths. The president also threatened to pull out of a meeting with President Xi at the end of the month. This meeting coincides with the end of the latest 90-day reprieve between the two countries. So, this string of social media tit for tat and comments sent major indices into a frenzy. We saw the Dow Jones down around 1.9%, the S&P down 2.7%, and the tech-heavy NASDAQ down over 3.5%. Markets bounced back after President Trump once again posted on Truth Social on Sunday night, basically telling everyone, don't worry about this. This was just a bad moment from President Xi, and that the U.S. is trying to help China, not hurt it. So with this being said, we've seen markets rally basically since April. The one thing that knocked them off their ground was tariffs in April. So my question to you is there another kryptonite like you were talking about before, or is this more of a scar tissue thing for investors to say, hey, we saw what happened in April, we don't want that to happen again? Because in my opinion, I did think that the tit for tat discussions were over. Obviously, the implications of tariffs are still ahead of us, whether it's inflation, whether it's, money in consumers' pockets. But I did think that this tit for tat that has now come up in the last few days was behind us. So, my question to you is this just scar tissue that equity markets are feeling, or is this truly, once again, worry about the long-term effect of tariffs?
No, it's a great question, because when it comes to tariffs, or any other headlines for that matter, this is a headline risk world that we're living in from an investment standpoint. On any given day, at any given time, during any given trading day, there could be something that's said that could send the markets reeling. And yeah, there's still a sensitivity around tariffs. But one of the things we notice is that, okay, the market was down hard on Friday, but then it was up big on Monday. On Tuesday, late in the trading day, it kind of falls back down, but it was on its way back even before the trading day ended. We should be prepared for those types of momentary shocks that take place here along the way, but not anything like we saw in the spring, at least in terms of tariff announcements. The market has adjusted to the reality that tariffs are going to be higher. And we've seen the markets do just fine since April in this higher tariff environment. I think the biggest thing that we need to watch for going forward is what tariffs might feed into and play a part along with a lot of other different things. And that's the risk of a renewed rise in inflation. Tariffs can be inflationary. And there's a lot of other things that can be inflationary too, like cutting interest rates in an environment where the economy is continuing to grow and corporate earnings are still expanding at a double-digit rate. As we go through the remainder of the year, it's going to be really worthwhile to watch the monthly inflation reports, assuming the government reopens or there's somebody to publish those inflation reports. We're really going to want to watch the inflation data closely, and that includes the potential feed-through effects from tariffs. We haven't seen it hit the headline inflation numbers yet, but there's a real possibility that we could start to see that seep in by the end of the year, early next year, and that could spell trouble for the markets and more sustained trouble for the markets.
An area that I think that, we're talking about trouble, we're talking about what can knock the equity markets off its feet. an area that you've written about consistently, and it's not Burl Ives in the holiday season, but it is silver and gold, is, this idea that precious metals could be a hedge. But recently they haven't felt like that. In your latest article, you mentioned that financial markets tend to repeat themselves, and to steal a great line out of your book, investors tend to chase the shiny object. It just so happens that the shiny object this time around are the shiny objects. So, we've seen both silver and gold hit all-time highs, but both investments have, their negative characteristics. Gold, there's no cash flow, as you mentioned, there's no yield, there's no absolute valuation metric. And, before a few years ago, it really couldn't break through that record that it set in 2011. Silver was probably even more of an exercise in frustration for investors. As you said, it trades with 2 times the volatility of gold, and barring a 6 cent breakthrough in 2011, it had not gotten back to all-time highs that it set in 1980. So, investors growing up are taught that these precious metals or industrial metals for silver are hedges against inflation, or they're they provide correlation benefits within an asset allocation model. They don't feel like that right now. They feel like something different. So my question to you is why are they different? Why are we seeing what we're seeing? Or maybe the better question is what does it mean for financial markets that these 2 precious metals have soared over the last few years, but really the last few months and weeks?
Mm-hmm. No, it's interesting because what we're seeing in gold and silver right now is the latest evidence that, speculators going to speculate. And we're seeing that in gold and silver right now. You mentioned silver. Silver hit near $50 an ounce back in 1980. And it set a new all-time high at just over $50 an ounce here in 2025. That's a 45-year round trip to the same place with some down 80% paths along the way. That highlights the key point is that if you're investing in precious metals in isolation, be careful out there because they're volatile, and silver in particular is volatile. That doesn't mean that precious metals don't have a place in an asset allocation construct, however, because one of the advantages with gold and with silver is that they're uncorrelated with stocks and bonds. And what do we mean by uncorrelated? Basically, if stocks are going up, gold and silver are going to do their own thing. If stocks are going down, gold and silver is going to do their own thing. The same exact thing is true with bonds. So they provide a diversification benefit in an asset allocation construct because they help lower the overall risk of the portfolio because they're going to go in their own path. Now, right now, that path is definitively to the upside. There's a lot of liquidity out there. And over the last 2 years in general, and particularly since the beginning of September, that liquidity has been finding its way into the gold and silver market. Now, that's great for gold and silver investors. Doesn't necessarily mean you want to jump on that train right now, because the time to be in gold and silver was a couple months ago, if not a couple years ago, not now after it's had its phenomenal run. Because if any asset can rise 50 to 100% to the upside over a short-term period of time, it can go down 20 to 50% to the downside just as quickly. But one of the things that's important to recognize with this recent run up in gold and silver is to think about what it's signaling. Gold is widely regarded, we'll talk about silver and gold in the same context, but gold in particular is widely regarded as a hedge against inflation. It's how we've all come to know it, going all the way back to the 1970s. It's a hedge against inflation. Well, that's only partially true. It's a hedge against inflation only if the market perceives that inflation is going to run away and run out of control. If you look at 2022, we had high inflation and gold didn't really do all that well. Why didn't gold do well in 2022? It's because the Federal Reserve was raising interest rates by 5.5 percentage points over a year and a half. It was the most aggressive rate hiking cycle from the Federal Reserve since the 1970s. Why were they doing that? Because they were going to stop that inflation problem, and they succeeded in that. They're withdrawing liquidity out of the market, and that caused the gold price to go down during 2022, despite the fact that we had this big outbreak of inflation. not an inflation hedge, because the market perceived that inflation was going to stay under control. Well, why is gold running so much higher here in the second half of 2025? Because the market is worried that we might have an inflation problem that could crop up starting in 2026 that could run out of control. And that has important implications, not only for the gold and silver market, but also for stocks and also for bonds. So all the more reason we got to keep watching those inflation numbers as we finish the rest of 2025 and into 2026. Because right now, gold and silver are signaling we might have a problem on that front as we get through into the second half of the decade.
Well, there's certainly a lot to talk about in markets right now. It seems like it's a busy time between the AI trade sustainability, this renewed discussion between the United States and China around tariffs, and record runs for both gold and silver. So Eric, thank you for the great conversations today.
Evan, thank you as always. And thank you for joining us for this latest market insight. And we look forward to seeing you again soon.